Welcome back. You're watching First Trades live on ET Now. Straight off, let's connect with Ved Prakash Chaturvedi, Chief Executive and Investment Management with L&T Finance Holding, joins us live from Mumbai. Ved, good morning. Good to have you back on ET Now. First, characterize the market environment for us. If I ask the bulls are of the view that markets are holding on despite a bad news environment. The bears are of the view, look at markets, how markets have moved in the last 5 days. For sure, cracks have surfaced up.
My feeling is that we have to look at some global factors and local factors. A lot has been said about the Jackson Hole meeting that's happening in the US. Feeling is that nothing much will come out of it. The Fed will say that they have ammunition to do something more, but they're not doing it right away, and will watch the space carefully, watch for data carefully. Attention will be on whether the German Parliament will support the European Stability Mechanism or not, and whether the ECB bond buying program continues, and so on and so forth. So I think there is a lot of apprehension in the market because there's some news flow expected from overseas, which can have an impact on what happens to expectations of quantitative easing, which the market has been waiting for. On the domestic side, clearly GDP numbers are expected to be muted for the year. Consequently, earnings growth numbers are expected to be muted. Most analysts expect consensus earnings estimate growth for leading companies basket to be in the region of 10 to 12%. Given that backdrop, my sense is that we are going to remain in a safety zone. Focus of the market will continue to be on safe sectors, pharma, FMCG, etc. And while these sectors obviously are quoting at high valuation, hence the upside is limited, and clearly market will be a trading band. I don't think there is a huge downside given the fact that valuations are not overly stretched, given the fact that even in these bad times India has been attracting FII flows, as well as the fact that there are very few economies in the world which are still in a relative sense growing at the rate that we are growing. We have significant domestic concerns on growth, on some of the issues that have hit the front pages of newspapers in the last few days, and of course on inflation and interest rates. So I think, as I said earlier, on balance there's some good news and there's some bad news, and both upside and downside are limited.
Wait, so what is it that you're telling your clients in terms of a buy or a sell strategy? What sectors are you bullish on, and what do you think is going to underperform from the current levels?
See, as I said earlier, my sense is that given the significant uncertainty globally and now domestically, for the time being in the immediate future, it will be a bit more of the same. So sectors which have outperformed in the recent past, in the past few years, will continue to be the ones which are under focus. Though many companies' valuations in these sectors are stretched, and that is something worth keeping in mind. However, from a more medium-term perspective, I mean, an economy like India obviously needs infrastructure, needs construction engineering companies, needs its banks to perform, and so on and so forth. So I think from a 3-year, 5-year perspective, it is some of these sectors which are today appearing contrarian sectors which will outperform. You look at the performance of the mid-cap indices versus large-cap indices, and there is a story there. And several high-quality companies in the mid-cap space have underperformed. So I think clearly it would depend on the investment horizon and risk appetite of individuals. Somebody who cannot take volatility in the next 1 year should not venture out of the safe sectors, because my feeling is that the uncertainty that we are seeing will increase in the coming days, especially if there is an overlay of political uncertainty over what we are seeing, and that will have its own impact on the markets. The one silver lining I see here is that over the next 1 year, if there is significant news of the slowdown, and if there is some containment of inflation or even early signs of oil prices coming down, interest rates may come down, and that may be a positive sign. So I think markets will wait and watch for these signs. I think in the immediate future there will be a continued flight to safety. However, for 3 to 5 year investors, people who can really think out, stick their neck out, I think some of the contrarian sectors are extremely good bets.
Ved, markets love to hit the entire infra space. Do you think infra is where deep value is? Because investing is not about buying something expensive and popular. Investing is all about buying something which is cheap, attractive, and which is out of flavor.
As I said earlier, yes, absolutely, but it is a question of the time frame you have, and also in each of these areas, when the tide goes out, the boys and the men are separated, and I think that's what happened. So there are some high quality companies quoting at very good prices, and that's what one should look at. But again, I repeat, it is not, I think, going to turn in a hurry. It is a medium term bet. But certainly for economy like India, these are sectors which have to deliver, which have to perform, and there are some very high quality companies. Then investors should watch out for them.
Ved, what if after the monsoon session of Parliament we get nothing from government? As of now, there is a hope trade that once the monsoon session of Parliament gets over, we will get some token diesel price hike, maybe something on retail, maybe something on FDI insurance. If none of the following reforms kick in, what happens to market in that scenario?
That is a point I made earlier, that in addition to the business uncertainty and the uncertainty with respect to earnings growth and the global situation, we now have some overlay of political uncertainty. I think all of these will combine to cause a situation where if there is an event, for example, a downgrade or something of that nature, we must brace for some downside. So while I guess over the next 1 year, I am optimistic about Indian markets in the sense that I think a slowdown in growth will cause interest rates to come down, which will be a positive trigger for sentiment. It may also kickstart the investment cycle. We already have, I think, a strong consumption cycle going, and I think the both together will then start to revive the animal spirits in the market. But at the same time, in the immediate future, given the uncertainty in the areas that we spoke, if there is an event of any nature that happens, I think that will spook the market significantly.
But the reason why markets like consumption stocks or defensives is because they have predictable cash flow, cash on balance sheet, and strong return on equity. But is it time now to log out of some consumption themes, especially large cap FMCG and maybe large cap auto? Because if I look at data points, auto sales are slowing down, mall footfalls have fallen, and the kind of commentary we've got from some urban retailers, it's quite scary.
See, here's what I think will happen. I'm just looking into my crystal ball, and these are my personal views. My feeling is that the consumption story is running very strongly in our country. However, stocks are completely reflecting that consumption story. Now, any story cannot run forever, and you're absolutely right. I think we are seeing some early signs of slowdown in certain areas, and maybe these sectors will peak out over the next 6 months. If at the same time, as we anticipated earlier, if interest rates start to moderate and focus and smart money then starts shifting to certain other areas, we will see leadership pass. So my sense is that the last part of 2012 and the year 2013 will be the year when we see leadership pass, but it will not be a sudden process. It will be a very gradual process, and I think some of that will really be dictated by how the investment climate turns, which will in turn be predicated on interest rates, some amount of overseas flows, and some decision making in the corporate sector.
Ved, so if I look at the current scenario, it reminds me of the 1997 scenario where inflation was high and interest rate or the investment cycle had broken down. But what happened after that, we pretty much know as history. Is it time also to bet on a short-term debt or some fixed instruments? Because if Reserve Bank of India cut rates before equities, bonds will appreciate.
No, I completely agree with you. I think it is a time when while the market seems to dictate that more of the same is safe, I think smart investors have to think about how the environment will change. Noises and voices for interest rates to come down are now in front pages of newspapers from eminent financial service professionals. And some of this will be heeded too. So I completely agree with you. I think time has come to take a relook at the portfolio, and maybe a little more aggression in bond portfolios will pay over the next 1 year.
What about other basic assets? I'm asking you very basic personal finance questions because they are of immense market curiosity. Is it time to sell gold? Is it time to sell that extra house you own?
Well, Nikunj, as you know, I'm not an expert on gold and housing, but yes, one of the fundamentals that I've learned over my 20-year investment career is that no one asset class can keep outperforming. There's been a big bull run in gold and in real estate in India. It seems unending, and it seems foolish sometimes, or it sounds foolish to say that take some profits out. But whoever has made a lot of money in these asset classes, I think a good argument would be to take some profits out from these sectors and put it into another underperforming asset class. It is amazing, isn't it, that over a 4-year, 5-year period, if you look at equities as an asset class, it has underperformed in India, which is a growing economy, almost all other asset classes. And I think that is the story. And people who learn from history would certainly start to look at equities as an asset class, think about the next 3 years, and take some profits out of other asset classes where performance has been there and put some money into equities and equity mutual funds.
Well, Ved, appreciate your time and good to have you back on ET Now, and we certainly hope to see more of you going forward.